Okay, well, welcome back to New Life's three-part series about how to manage your business from COVID to success. This is part two. In case you missed part one, I just want to remind you which part we're on. So in part two, we're going to talk about decision-driving metrics. Now, this is one of my favorite topics of all time, so I'm glad that you've reserved 3 hours for us to go through this because it's going to take 3 hours. No, I'm kidding. You would have hung up already. I get it. We're not going to take 3 hours, but this is it's a very important part for me, and it is something that I'm extraordinarily passionate about. So what does the term decision-driving metrics mean? So it's easiest to understand if you're thinking about your own board meetings, right? So in your board meetings, somebody's looking at a spreadsheet, there's a projector with a whole bunch of numbers on the wall, and you know what else is in that room? Everybody is shut off. They are glazing over and they can't wait for the numbers deal to be over, right? So when metrics are really well presented, what they should lead to is awareness, right? Awareness about how are we really performing. And within that awareness, the other second part of awareness is realization. So within realization, that means I'm doing okay, I'm really not doing okay, and I need to take action, or I'm doing great. So it should be a relative measurement about how well am I doing and do I need to take action. So when you know how well you're doing, then the last piece is what are we going to do about it? What actions and behaviors will we take to change these numbers? One of our CFOs, and I'd like to say it was me, but it wasn't, has this great saying, and it's basically, hey, look, your financials, they're nothing more than a historical reflection of your people, their decisions, behaviors, processes, and systems. Therefore, if you really want to change your numbers, you need to look at what your people, their decisions, behaviors, processes, and systems are doing. Because it's only through changing those things that your numbers are really going to change in a sustainable way. So, why do I like metrics? Why do I like these data points versus just a big spreadsheet? Because they communicate differently. Now, if you're a CFO or an accountant or everything, you can look at the spreadsheet and kind of see the relationship of the numbers. That's because we've been doing it for decades. The average human being does not digest spreadsheets well. So when you present metrics, I will highly recommend that they are done graphically. You know what? Because most people in that boardroom are visual learners. So don't present the information to them in a way that is not aligned with their learning behaviors. So if you look at the average CEO or C-suite people, you're going to find a high propensity of people that might be ADD, visual learners, and kinetic learners. They are not going to want to stare at your big spreadsheet, so don't present it that way. So when we're looking at decision-driven metrics, here's the optimal outcome of any board meeting that you have like that. That people look at the presentation, they have awareness of what's going on, and they can leave the room and take action immediately to change the numbers. Now, if they just leave the room and they have more awareness and go, oh, that's great, we're at 2 million versus 2.8, or we're at 2 million versus 1.8, that's interesting, but nobody's taking any action. So again, if they're not going to take action after the board meeting, you miss the mark. Metrics can really do that very, very well. So our standard within our metrics is we're going to identify a metric that we think leads to an important relationship in your numbers. But within that metric, we're always going to tell you what is an outstanding performance, what is an okay performance, what's an at-risk performance, and a holy smokes, you better do something different performance. That's critically important because if you do this well and you define those targets and performance levels in advance, you know what it does? It eliminates the debate. So usually when they're presenting a number, they go, oh, that's a bad number. Then what ensues after that is about 20 or 30 minutes of wasted time where you debate how bad is bad and how good is good. Total waste of time. So when you define these parameters up front, you have agreement up front that if I hit the number is now 1.5 million, we are going to take action. We agreed in advance that we're going to take action. And if we know what number that we're looking at, then we know it's either going to be Jill that takes action or Jack that takes action. But we know what action to take, when we're going to take it, and who's going to take it. Now imagine that everybody just left your boardroom and they had that kind of information about who, what, when, and how much. How much more powerful is that going to be in your next 30 days? So here's an interesting stat for you. Let's say that you're sitting in your boardroom, right? And you're going through your monthly review meeting. How hard would it be if you had really good metrics to find just 3 things that created just $2,500 of benefit, savings, or incremental profitability each month? $2,500. Just $2,500. It's not a big goal. Here's the power, though, if you actually do those 3 things of $2,500 and you do it consistently every month, by the end of the 12th month, you will have created, and let's say that these are recurring savings or recurring benefits, you have created almost $1 million worth of difference to your bottom line, to your cash flow. So identifying the things, taking action, and doing so to where they're done is critically important to incrementally improving your business. Now, we're going to dive into some of my metrics. And I'm going to try and keep this as entertaining as possible, which for some of y'all is going to be, oh my gosh, there's no way a discussion on metrics is going to be entertaining. So the other aspect about your metrics is you're looking at historical data for the most part. And you're like, that's already gone. How does historical data help me? Well, it helps you in really powerful ways when you start looking at your historical data and saying, what does that tell me about my future? Because that's really the key. And so if you're just looking at once a month, your P&L and your balance sheet is a singular deal, you're almost getting no information whatsoever. Information needs to be compared over time and in relationship to other things. So if you think about your balance sheet and your income statement and the components of that, I'll tell you that. So let's take your income statement for example. I mentioned in the last video that if I talk to a bunch of CEOs, they're going to say that the first 2 things that they look at in their financials is their revenue and their net income. And I tell them, number 1, you just looked at 2 very misleading things, especially if it's just a point in time. Number 2, you just described 2 pieces of bread on a sandwich, the top piece and the bottom piece. Now, how many of you in this audience ever buy a sandwich because of the bread? Not many. Same thing is true with your income statement. The things that really make it very interesting and tasty is everything in between and how they relate to each other. And your metrics should help you to understand those relationships of those numbers. So that's what we're going to focus on. So we're going to start out with your revenue. We're going to work your way down, and then we're going to go into your balance sheet. We're not going to do all my favorite metrics, I promise, because it would be 3 hours. So when we're looking at your revenue, don't look at just a month. Don't look at 2 months. You want to look at a trend of revenue. And you want to look at the composition of revenue. So by a trend of revenue, one of my favorite things in the world is look at your trailing 12 total revenue. So each month represents 12 months worth of revenue. You're asking, well, why do I do that? I could plot out my revenue and have a nice little chart. Well, for a lot of folks, your chart is going to have a lot of jigs and jags along the way. And you know what those are? Misleading information. If I take a total 12-month projection and I put that in there as my data point and I chart that out, I'm going to see how I'm progressing. Is this month's total result better than last month's total result? Because now I have 12 months results. What it also does is it eliminates the distortive effect of seasonality, cyclicality, and it also eliminates the distortive effects of one really good month and one really bad month. Because we always have 12 months worth of data. And if you look at that, what's really crazy, let's say that you're a growing company and your chart shows that it's growing, and I'll try and do this the right way since you're on that side of the camera, that's going like this and it's going up. So if I have 12 months worth of data and suddenly that thing dips, it's a very powerful signal that something very real has happened to your business. Because something happened in that month that's heavy enough, or in the last couple of months, that is heavy enough to change the direction of 12 months worth of data. So when you see some of those blips, the static, as I call it, of a line chart, it eliminates the ability to make excuses about getting too excited about the peaks and dismissing the valleys, because now your data says something very different. I'd like to take credit for this, but I can't. Some of y'all that have been in CEO groups have probably heard of a guy by the name of Craig Kramer, who unfortunately passed a few years ago. But he was the disciple of this total 12 months trends, and I highly recommend it for everything that you do. It's wicked powerful when you're looking at gross profits, when you're looking at revenue, when you're looking at net income, and when you're looking at a lot of other stats. We're not going to focus on that for everything, but I did want to point out how powerful it is on revenue. Here's some other things that are really crazy powerful about your revenue that you need to be trending now. The composition of your revenue. And I'm going to talk about composition in two forms. The first composition of your revenue that you need to look at is project versus recurring revenue. So if I'm a project company, and I was at one point in time because I owned a construction company and it was nothing but projects, you're literally having to recreate your revenue every month, right? So I could go from having large projects and a lot of revenue to no projects and no revenue in any one month. Here's the other thing that's very important about project revenues. If you have large projects and something happens in the economy, your revenues are going to drop off like a cliff. However, if you have some level of recurring revenues, it creates this nice cushion. So monitoring the composition of your revenue, what percent is represented by ongoing transactions, and what percent is represented by these lumpy projects is very important. Here's why it's important. If you have project-based revenue and you have big projects that are big and lumpy, what you also have is a risky profile to your business. So think about that. Think about when those big projects go away, what it does to your business, because you could go upside down really quick if one customer or two customers just postpones or delays a couple of big projects. Now, how do you manage that? What does that really tell you about your business? Well, what it tells you is how you need to manage your costs. If I have big, lumpy projects and a lot of raw projects that represent the composition of my revenue structure, and that can be volatile, then I need a highly flexible cost structure so I can pivot quickly. But let me tell you, if you have lumpy project-based revenue and you have a very sticky, fixed cost structure, you have a very high-risk business. Now, it's not only risky for you, I'll tell you that at the end of the day, it's also going to dilute the value of your business to a potential buyer. Because with increased risk is decreased price every time. The other part about composition of your revenue is looking at your revenues through your customer's eyes. Is it discretionary purchases to your customer? Because if it's a discretionary purchase to your customer, you know what they can do? Turn it off. So in my previous business in construction, I was in commercial flooring. And let me tell you, I found out the hard way, commercial flooring is a very discretionary expense to my customers. Because when the recessions hit, they stopped immediately. They didn't care a whole lot that their floor was 5 or 6, 7 years old. They cared that their doors were open. So guess whose revenue stopped like overnight? That would be mine. So I take these lessons very seriously. So when you look at that, understand not only is it lumpy, is it discretionary to your customer? Because that also means that it's riskier to you. The other part that I'm going to say composition is what is the concentration of your revenue? So that could be industries or whatever. So that's going back to that. Is it a discretionary purchase by your customers? But the other thing is how many of your customers, if you took your top 5 customers, what percent of your revenue is represented by your top 5 customers? So let's say that you have one customer that represents 25% of your revenue stuff. You are at a risky position. Any one customer that represents more than 25%, you have risk. Right? Because you're really one decision maker away from losing 25% of your revenue. And if your top 5 customers represents 50, 60, 70% of your revenue, wow, you're only 5 decision makers away from having a really big problem. Now you're going to tell me that those all don't happen at the same time, but you'd be stunned when one customer has a problem, there's typically a problem within their industry, and a lot of customers start making the same decision. So be very careful about those 3 components of your composition of your revenue. Now, the other thing to understand about your financials is they are more meaningful when you look at the relationship of numbers to one another, right? So we're going to be diving into that, especially when we get into your COGS and your margins. I am going to finish out about some important other metrics that are pre-revenue metrics. So by pre-revenue metrics, it's like, what the heck is that? Pre-revenue metrics would be like your backlog. So let's say you're a manufacturing concern, you're a distributor, or you are in construction or some other of those types of industries. You're going to have a backlog of revenue. So my favorite thing to do is take your planned monthly revenue. So let's say that you're a $36 million company and you have $3 million on average of revenue per month. Great, 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 great. And your backlog is $9 million. So effectively, you have 3 months of revenue in your backlog. So keep that in mind. And what you want to do is you want to calculate that for when you were a healthy company, right? When you were really doing strong, and that might show you that you had, when you're really strong, you had 4 or 5 months worth of revenue in your backlog. So with that, what does that tell you? If you have 4 or 5 months of revenue in your backlog, it means that you have 4 or 5 months of a runway to make decisions about your business. Historical information being used to make decisions about the future of your business. Crazy powerful. Crazy powerful. So you're clicking along and you see I have 5 months. I have 5 months. I have 5 months. I have 4 months. I have 3.5 months. You have to take action, because you're now only 90 days away from your business being systemically smaller than it was just a month or so ago. So as you're looking at this, you might actually get into a rolling 3-month average. So no 1 month skews this. But as you're rolling that, you go, I'm healthy. I'm healthy. I'm healthy. I'm not. I'm going to take action. So it really gives you 3 to 5 months of time frame to start addressing and mitigating or adjusting your costs so that you don't get into a surprise situation and upside down and needing to go revisit your 13-week cash flow. So that's really crazy important. Here's the other thing that it does. So let's say that I'm talking to my salespeople and suddenly my sales cycle is 4 months, right? And my number of months of revenue goes from 5 to 4 to 3. Ding, 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 red alert, salespeople. Somebody needs to go close some business so I can get this thing back to 3 months, because now my pipeline, my backlog is now smaller than my sales cycle. So if I look at the number of months of revenue that I have in my backlog relative to the time it takes me on my sales cycle, it will tell me if my natural processes are structured in a way to repetitively fill my bucket of future revenue. We're going to talk about another metric on future revenue that I think is crazy powerful. And most people perceive this one as being a negative measure, but it's probably the most positive measure you'll get into. And it's called break-even point. You know, like break-even point, I'm not in business to break even. I'm in business to print money hand over fist. Well, of course you are. Here's where break-even is really important, though. When you understand your break-even point, what that's telling you is it's a combination of your revenue, your margin, your cost composition, all in one metric. And it's crazy powerful what you can do with that metric in a couple of different ways. So first, when you're looking at your break-even point, it's going to tell you, hey, I need $1.5 million every month to make sure that we're going to be positive. Really, two very important things out of that, it's $1.5 million. Number one, if you hit $1.5 million every month, you're not going to have any month with a loss. That seems pretty self-evident, yes. But when companies have months of losses, and if they can just eliminate the negative months, it's crazy what it does to their total profitability. Because now the drags are all gone and they've replaced that, and you want to see a company go from 5% operating income to 8%, go eliminate the negative months, right? So what you can also do at this break-even point when you're in your weekly sales meetings is you can constantly be challenging your sales folks. What are we doing 5 months from now to make sure that we have this $1.5 million, $2 million, whatever your break-even point is, of bookings and sales that will go out the door? And you can start looking at your projected sales from your salespeople and saying, okay, we're at 1.5, we're at 1.5, that looks like it's going to be 1.1. This next one's 1.7. Who's going to pull some deals forward so we eliminate this negative? Too often people will go, oh, it's okay because it's still all this revenue. What it really does is it creates the proper amount of anxiousness about filling that hole. And you can incentivize your salespeople to always make sure that there's never a negative month. And when you do so, it's a crazy, powerful discussion about how many months in advance are you always filling out that hole. So break-even point is a critical measure. I could go on and on about it because it's probably one of my top 5 measures. I won't, though. So one of the other things that we're going to talk about now that we're getting down into your margin, we're going to really start talking about your operating leverage. And what that means is how much money are you systemically able to produce relative to your cost structure? Now, for the vast majority of you, if you looked at your income statement and you grouped it in a different way, you're going to see some unique relationships between your revenue and your cost structure. Number one is, let's just talk about your gross margin. We all know what gross margin is, but I'm going to change the word there and talk about your contribution margin. Now, what is contribution margin? Some of you accounting geeks out there know exactly what I'm talking about, but the average human being typically doesn't. What your contribution margin is revenue less direct materials less direct labor equals my contribution margin. And then you have a bunch of other costs. It might be freight and other things that get down to your gross margin. What does your contribution margin tell you? If you're looking at your contribution margin, that is a number that you can manage as soon as you walk out the boardroom. Right? So we're monitoring our contribution margin as a percent. It's 50%, it's 50%, it's 50%, it's 45%. Well, what the heck happened? And then we find out that our labor went sideways. So the person that's responsible for operations can leave the boardroom, go right out the deal, and start working with their team to make sure that that gets corrected, and labor fixes itself to where your contribution margin is back up to 50%. And by eliminating the rest of the stuff in your COGS and just looking at those numbers to get down to contribution margin, you eliminate a lot of the static out of the conversation. Because some of those things may or may not be readily controllable as soon as I walk out of the boardroom. But your contribution margin is, both on your purchases, what you're doing with your vendors, and what you're doing with your labor. The really big metric that I want you to focus on is units per man hour. Okay? Now, that doesn't sound like revenue per se, but it's a really powerful deal. So if you're tracking units per man hour, it's a very simple metric. It's one line on a chart. So we've done this with a couple of companies, and one, it's my favorite deal, and I can't say what the company name is, but their labor was a problem in their contribution margin. We pointed out that it was going all over the place. And so, we got to go fix that. We don't know what to fix. We're going to have all these metrics like timeout. Let's have one metric to start with. They said, why one metric? It's like, if you have one good metric, your people are going to understand it. And with understanding becomes action. Also with understanding becomes questions. These questions will lead to your next layer of metrics. But let's continue with the story about this one metric of units per man hour. Within that deal, if you looked at their chart, it was bouncing all over the place, units per man hour. And so what we did when we graphed that all out, we graphed it to where, again, we set targets. And what we showed them is, hey, if we can get within this band range of performance on the units per man hour, the company will consistently be profitable. And that's the only metric that we had out there. Now, in this one shop, if you went to their shop floor, there's 3 different languages spoken. So does that mean that we're going to have 3 different charts? No. One chart, one language that everybody could interpret very easily. And as they walked by it in the break room, they'd know that they're on track or off track each day, each week. And what we did is we highlighted the peaks. And so it might be a valley. Oh, we spilled a bunch of stuff on the shop floor. It shut down production. So our units per man hour was killed. But now they know the impact of what that happened to their units per man hour. On another day, it's like, oh gosh, everybody was humming. We had no problems. And the units per man hour was up here. Well into the high range of profitability for the plant. So cause and effect starts to be identified readily within your people. Behaviors then change. So what was interesting is we had that bandwidth about here's where we want the things, your units per man hour to go. After 1 month, guess what happened? Zoop. All the production started going right to that small bandwidth. The next thing we did is, obviously we congratulated him, good job. The next thing we did is we put together a deal that says, hey, if we get to this band, so we had the band of profitability, and then we put in the band of bonusability, right? So we told everybody, if we can move the production per man hour to this one, then everybody's going to start getting a bonus. Guess what happened with production per man hour? You guessed it. It went exactly into the bonus zone, and it was a very tight zone and stayed there. So over time, and literally it was like 3 months, the volatility went away, the profitability went up, and everybody started making more because they were producing more for the company. So a great way to do bonuses is not to just hand out money, but tie it to things that produce more money for the company. And that's just one metric. So changing those behaviors is very, very important. One of my other favorite things to do is just revenue per head. Because it's going to tell you totally how effective your people are doing. The other thing that's great about revenue per head, it's one of the few operating stats that you can get in any benchmark report. Any benchmark report. So you want to have a really good stat about how you're doing relative to your competitor, go get revenue per head. Now, there's a couple places where you can get benchmark information. Just send me an email. I'll be happy to point you to 2 or 3 resources. We subscribe to a big database called BizMiner, which is great, and we do this for all of our clients. So revenue per head. And what it allows you to do is it eliminates all the excuses in the board. Oh my gosh, we're doing annualized $200,000 of revenue per head, and now we're at 205. That's awesome. Until you look at the mirror of somebody else's data and you see that they're doing $250,000 per head. Now you have a different conversation about why. Now good is not good enough, because now we know that somebody else is performing better than you. Not only are they performing better than you, they are creating more resources than you in their own company. And with more resources, they could do more marketing. They could do more brand awareness. They could do more customer engagement, which means they're probably going to take your market share over time. Sorry to be so draconian, but it's true. If you're not performing at least as well as your competition, it's not going to be too long before you don't have the market share that you're going to have. So here's another great, powerful deal for all those people who are not a part of your production team. So, below your line, when you reorganize your income statement, you're going to have, we always put all of our sales and marketing together. And then we put all of our head count together. And then we put some of the other expenses down below. So by simply putting those things together, immediately by having all our sales and marketing, I can always ascertain what is my return on my sales, right? So if my sales and marketing is 10%, that's outstanding. But if I hire a new salesperson or a new sales manager and they're going to tell me how they're going to invest in 10 new people to really drive sales, I'm going to ask them, okay, that's great. When we put all that cost in, I still want my cost of marketing and sales to be 10%. So you want to put in $500,000 worth of new people? That's fantastic. I need $5 million worth of revenue. So that's a different conversation of accountability when you have those kind of metrics. So since that we've kind of covered off on one of the key metrics for your salespeople, your sales and marketing expenditures, return on that, I'm going to shift into the total administrative deal. So here's my favorite metric for understanding how productive your administrative staff is relative to the profitability of your company. So what I like to do, similar to revenue per head, is take gross profit per admin head, right? So also do that at your best time, because that's going to tell you how much profit per head was really cranking through your company when you were healthy, strong, and printing money. That should be your target. Use that as your target and then start benchmarking yourself against that target as you go forward. And what you're going to find is you have, hopefully, you don't find anything, but what you may find is that you have gaps, and those gaps show you where you're diluting profitability either because your sales are coming down, your pricing's coming down, or you're hiring too quickly, right? Number one reason that people get into problems is what I call irrational exuberance. And no, I'm not trying to be Alan Greenspan here. Irrational exuberance has to do with CEOs, presidents, and owners love to hire people based upon future revenues. That's what you say, tap the brakes here. Let's hit the pause button. We don't need to go out and commit a bunch of money to people for future revenue. Let's stress our people for the current revenue until they get to a certain level of overtime, and then we'll go hire people. So what typically happens is people go, oh, our business is going to boom. We're going to be at, instead of 2 million, we're going to be at 4 million. I need to go out and double the number of people that we're going to hire and bring them on board. So what's happening there? Until that 4 million comes, their revenue, their gross profit per admin head starts going down and down and down and down, which means their profits are being diluted over and over and over. Here's another really good metric if you want to do this one. Take your same thing as far as your gross profit per admin head, and then graph a different secondary line, and that is average compensation per admin head. So this is crazy powerful, because if these lines are staying perfectly apart, fine, you're doing great. But they start crashing together, either because your margins are coming down or your staffing is going up, it's not long before you are totally out of business. And it'll scare the dog out of you sometimes when you look at these two charts going together. It's the best way to know that you are balancing your hiring with your margins and not getting over your skis on doing that and overcommitting your costs. So I've talked a lot about your profit drivers. That's probably enough about that. I will tell you that if you're interested, on our website, there's a whole document about my favorite metrics, how to use them, how to interpret them. And if you want, there's a spreadsheet out there. So you can go load in your own data and drive all these things. But for the sake of honoring my commitment for this not to be a 3-hour deal, I'm going to shift over into some liquidity and now balance sheet metrics that are crazy powerful. Now, liquidity. Most people have heard the word, but they don't really understand what liquidity is. So liquidity should be the measure of how much resources do I have to operate my business for how long. How many liquid resources that will convert into cash to run my business. So you've probably heard of things like asset ratio, quick ratio, and some other things like that. I can count out of 100 people, there's probably 5 that really know what those metrics are and know how to use them as management tools. All 5 of those are CPAs. So not too many business owners are CPAs, and I know a lot of CPAs that don't know how to use those metrics for managing your business. So we changed that conversation. We have a metric that we use called OPLIC, which is a clever way of saying operating liquidity. And here is the metric for OPLIC, or the calculation for OPLIC. You're going to take 3 months average cost of goods and 3 months average operating expense and add those together, right? So just tuck that number away. Then what you're going to do is you're going to take your cash balance plus 80% of your AR, and that's going to be your numerator, right? And then you're going to take that average 3 month of COGS and your operating expense, that's going to be your denominator. And what does that tell you? What it tells you is how many months of liquidity you have to pay for your operations, right? So we have cash and receivables, your 2 most liquid assets. We have your monthly average of those expenses that we just talked about. So how many months can you operate safely? I will tell you almost universally, people that have less than 1 month of OPLIC using that formula, they are moving the chairs around on their decks to make sure that they don't run out of cash, right? And so if you want to have a quick measure about whether or not you need that 13-week cash flow projection that we talked about last time, if your OPLIC is less than 2 months, you need a 13-week cash flow because you're just too thin, right? We actually had some companies that were down to 4 days of operating liquidity. You talk about somebody holding their breath every time they walk out the door, hoping that money has come into the mailbox and that they're walking back from the mailbox with a check in their hand. It's those people. Here's the other really great thing about operating liquidity is that it's a quick measure that you as the CEO or business owner can go, I'm okay, I'm not okay. I'm concerned about cash, I have plenty of cash. Here's the other really great thing about it. I have enough cash so I can take some money out of my business. I don't have enough cash to take money out of my business. So what we recommend is we really want people to have 3 months for the average business of OPLIC. At 4 months, you're very healthy. If you get to 5+, you can probably start taking some cash out of your business. You can go back and tell your husband that you're finally going to buy that lake house that you've always been talking about or whatever. However, you don't want to take cash out of your business when you're at 3 or less, because now you're jeopardizing the company for the liquidity it needs to sustain its activities and its customers. So here's what happens when companies are growing fast and they take money out or they starve themselves on liquidity. The company gets up here, they get more focused about having to move the chairs around the decks. More of their attention is readjusting everything else instead of serving and executing. And so their business settles back down to the level of activity that their liquidity and capital structure can sustain normally. So you get it up here, you take too much cash out, all the wheels get loose, your lug nuts are off, things are getting ready to fly off, and you're going to have to stop the car, go out there, tighten the lug nuts, change the tires, do all that other stuff, which means you're not progressing. That's the simplest analogy that I can have about the critical aspect of liquidity. That's a number 1 metric. Here's some other things that you need to look at that help to drive liquidity. Days sales outstanding. It's in your receivables. And what that basically means is, let's say that my average revenue is $1 million and I have $3 million worth of receivables. I have 90 days of revenue, right? So 1 month is $1 million. Take the 3 divided by that. I have 3 months. 3 months times 30 days. Doing simple math here. I have 90 days of days sales outstanding. When we get into companies that are short of cash, the first thing we're going to do is look at your balance sheet. And the first parts of your balance sheet that we're going to look at is your fat assets. Now, I have to be very careful there, and we both know why. But if we look at your assets that are too heavy, then we can start to attack those assets to go create cash. Because I'll tell you, if you truly have 90 days of sales outstanding, you probably have twice as much AR as you should. Most companies will range between 32 days and 45, maybe 50 days at the max. But if you have 90 days, you have way too much cash stuck on your balance sheet. So it's in your customer's bank account and not in yours, and it makes you feel good because it says AR up there. Don't feel good about that. So by looking at that, you can now create a metric for your collections team. Says, hey, whatever you're doing over there, we need to change our behaviors to get our DSO down to 45 days. And so let's say that you have that $3 million hung up in your receivables, you get it down to 45 days. You know what you just did? You put $1.5 million in your bank account, not your clients, not your customers. So you want to talk about having plenty of cash to run your business, it's probably stuck on your balance sheet. The other really critical metric that we'll look at as far as your working capital components is days in inventory. So it's a very similar deal, and you're going to do that math. I'm not going to go through the math about how to do it because that's boring. It's boring for me. It's got to be boring for you. So you can go to our website, go get it. But here's what's really important about days in inventory. So let's say that you have a lot of stuck inventory and your days in inventory is, 120 days. It could be the 90 days. Even 90 days for inventory is still high. You have 90 days of sales already purchased sitting on your yard in your warehouse somewhere that's just sitting there. That's not good. Now, you may look at your inventory and tell yourself that it's an asset. I'm going to look at your inventory and tell you that it's a write-down waiting to happen. It is a write-down waiting to happen. It is bad news on the horizon until it becomes cash. And it doesn't become cash immediately. It goes from cash, it goes from inventory to receivables, and then cash. So now we're getting into your cash conversion cycle, which is I'm going to take my days in inventory, add my days in sales, and subtract my days of payables, and that's my cash to cash cycle. So let's go back to the example that we were just talking about. We had 90 days in receivables, and we're just going to say 90 days in inventory, right? So we're at 180 days, 6 months of cash that's stuck in our balance sheet. And let's say that our vendors are really tough on us and they make us pay within 30 days. So we go from 180 days, maybe we have 30 days of good graces here, and that brings us down to 150 days. You literally have to have enough cash to operate your business for 150 days. So just think about it. If you really want to take money out to go get that lake house, you're going to have an op that's like 6 months to sustain that level of activity to support your business. And it is crazy powerful. So when you're looking at your accounting team, you challenge them to do that. Because again, your inventory is nothing but a write-down waiting to happen. So as we move on down the balance sheet, we're going to get into some things that you don't care about, but your banker does, right? Because there's a couple of stats on your balance sheet that your banker is crazy vested in. So if you want to know what your banker thinks before you go in there, I want you to look at a couple of things. Now, the weakest of this is going to be return on assets. You might think, why didn't you say return on equity? And here's why. In small businesses, the equity is frequently used as a distribution to the owners, so it fluctuates a lot. It can be up and down depending on profitability and distributions, whatever the case may be. That's less true with a big, large public company, so it's a great return on equity. It's a great measure for that. Return on assets, it's a very consistent metric for you, so take a look at that. And that's just as simple as taking your net income divided by your gross assets. And just trend that out because you're going to see some interesting things. It's also a number that you can also get benchmark data on readily. Some other things that your banker is going to be wanting to make sure that you're in tune with is your debt to equity, right? So that's literally a very easy calculation of your total liabilities compared to your total equity. Now, you may get really sexy on this thing and go, I want to know the relationship of my senior debt, aka bank debt, to my equity. because the bank really wants to understand the balancing act between how much equity or how much capital they're putting into the business versus how much capital you have in the business. 4-to-1, going to be kind of a high-end number there. So in that case, you would be having $1 million worth of debt and $250,000 worth of equity. And at that point, the bank is going to start looking at it and going, hey, I think we're the equity providers because we have so much more money in this business than you do. Especially if they see that you're taking money out regularly without paying down your debt, makes them very, very nervous. It's probably also one of your covenants that you have within your bank loan. So some of the key metrics that we're going to talk about are actually some of your covenant metrics. The other one is going to be interest coverage. So the bank wants to know that you have plenty of cushion to pay for their interest every month. And that's important for them because if interest stops on a loan, it signals something else to their reserves, and they don't want to touch their reserves. So monitoring your interest coverage is critically important. And what that is really looking at your net income divided by your interest. And there's a certain ratio that you'll see within your covenants that you want to have coverage on. 1.5 to 2 for total debt service coverage is good. And you probably want 2 to 3 on your interest coverage. And what that allows you to have is a certain level of volatility to make sure that you're okay. The last series of metrics that we're going to look at are really customer metrics. And this has to do with really how stable is your revenue structure. So some of the key things here is we did already talk about what percent of your revenue is coming from your top 5 customers. So it's a concentration risk. And concentration risk has to do with the risk of your business. It's also going to be a metric for the risk of what your banker sees. Now, I'm not going to go into banker metrics right now because that's a totally different topic. So we're going to have a different video on banker metrics because right now we're focused on metrics to help you manage your company. That is a total separate metrics about how to manage the relationship with your banker and the viewpoint about how your banker sees your business. So we're going to dive deeper into that, but in a separate video. So on this one, we're going to finish out with the customer metrics. So how many of y'all have ever heard of customer acquisition costs? Okay, because it's really very important to see the net return on your sales and marketing activity relative to your customer acquisition cost. Now, if you've ever been somebody that watches either Shark Tank or The Profit, you know exactly how important it is because those investors all the time want to know what is the customer acquisition cost because it has to do with how efficient you are at gaining new customers. And the other thing they're going to ask is, what is your customer retention ratios? What is your churn of your customers? I gain 50, I lose 50. Well, that's not very good. I gain 50 and I lose 5. So looking at your customer churn, your customer turnover is really very important. And the last metric that we encourage everybody to understand is what is the lifetime value of one of your customers? So that's a combination of the other two is about what's the cost of getting your customers, how long are they going to stay here, and what's the profitability of your customers. So knowing those two things, really doing the math on that, tells you what is the lifetime value of your customers. Now, that's important to understand how effective your marketing and sales endeavors are and how good your operations are, because the better your operations are, the stickier your customer is going to be. So that makes great sense. Where it's really crazy powerful is when you want to sell your company, right? So these metrics totally differentiate you from everybody else. When you can show somebody that, my customers tend to have a very low customer acquisition cost, and we've been improving that over time, which means we're more efficient at bringing more customers to the table. And our lifetime value of customer continues to increase because once we have a customer, we can fulfill their needs more efficiently over time. You want to see, and then my customer retention, that once I have a customer, they stay with me a long period of time. You want to see the value of your company grow exponentially. We'll work on those things, right? Because it's a combination of your sales efficiency, effectiveness, and how well you deliver your products or services, all bundled up into a couple of things. It also represents a really great marketing collateral that you could sit there and go, hey, new customers, prospects, you want to know that our retention rate of customers is X%. And they'll know implicitly, and you need to brag explicitly about the fact that that is a definite attribute of how well you service your customers. So it's a sophisticated way of getting to a 5-star rating on Uber. So that's just how you need to think about it. You may deploy things like Net Promoter Score, which is great. That's also a great thing to monitor and to get feedback. But what you want is some indication about how long people stick with you and how close you are to that 5-star metric as far as customer rating, satisfaction, and stickiness. Those things will radically separate you when it comes time to sell your business. And the more that you have some of these metrics and you're demonstrating consistent improvement and monitoring these aspects, you will stand out huge, like a bright shining star when you're talking to a possible buyer. And even if you don't want to sell your company, you will stand out like a huge shining star to your banker. And again, we'll talk about those banker metrics on a side deal. But for now, that's all that we have today for our 3-hour presentation on exciting decision-driven metrics. I hope you enjoyed it as much as I do, because clearly this is one of my favorite topics. For those of y'all that fell asleep somewhere in between, just know that you can go to our website. You can download the spreadsheet, load your own data in there, and there's also a document that describes what these metrics are and what they should be telling you when you're managing your business. Thanks a lot for joining me, and see you at the phase 3.